Hi, my name is Lauren Hughes, and today we'll be talking about bonds for IW Finance 315, Week 5. The objectives we will be covering over bonds include what are bonds, the different types of bonds, and bond prices and why the prices fluctuate and change over time. What are bonds? Bonds are securities sold by governments and corporations to raise money from investors today in exchange for a promised future payment, according to the text in our textbook. Bonds were a former system businesses used to raise money in the form of debt. They are debt obligations. It is viewed just like a loan and needs to be repaid off over time. There is also interest that is to be paid to the lender. By paying interest, the buyers of the bond are lenders, now to the federal government. Governments and companies use bonds so they can borrow money in order to fund roads, schools, dams, etc., and even war if a conflict were to occur. They are looked at almost as like an IOU from their citizens. Also, bonds provide a solution by allowing many people to be a lender as well. Markets also allow lenders to sell their bonds to other investors or to buy bonds from other individuals at any given time. The different types of bonds there are government-related, corporate, or asset-backed securities. When it comes to government bonds, they can be issued at the national level and even as well at lower levels of government, like locally within your city or state. National level, known as sovereign debt, is backed by taxes and to print currency for the United States to use. All debt that is in the U.S. issued is risk-free security and is very safe. Governments also issue zero coupon or Z bonds. Coupon bonds are bonds that pay regular coupon interest payments up to maturity when faced with value is also paid. Two types of U.S. Treasury coupon securities are currently traded in financial markets: Treasury notes and Treasury bonds. Treasury notes are a type of U.S. Treasury coupon security currently traded in financial markets with original maturities from 1 to 10 years. Treasury bonds, a type of U.S. Treasury coupon security currently traded in financial markets with original maturities of more than 10 years. An example of a zero coupon with $1,000 par value and 10 years to maturity is trading at $600. The customer or person would be paying $600 for a bond, and it will grow in worth to $1,000 in 10 years. Municipal bonds are issued by state or local government agencies. They involve more risk, but the incentive/advantage is the munis, as it's called, is returns are free from federal tax. Corporate bonds make up a large portion of the overall bond market. Asset-backed securities are a third category of bonds that are issued by banks and financial sectors. Corporate bonds have more flexibility with how much debt they can issue. A corporate bond is considered short-term, when less than 5 years, intermediate 5 to 12, and long-term is considered more than 12. They have a higher yields than government securities because higher risk of the company defaulting than the government. The positive side can be most rewarding fixed income investments because of the risk the investor must take on. Companies can issue bonds with fixed or variable interest rates and of varying maturity. Asset-backed securities, ABS, they are created by packing up the cash flows generated by a number of similar assets and offering them to investors. If backed by several mortgages, it is known as MBS. So why do the price of bonds change? A bond's price changes on a daily basis. It's similar to like supply and demand. In any given moment determines that observed price. A bond doesn't have to be held to maturity. A bond holder can sell at any time in the open market and prices fluctuate. The price of a bond changes in response to changes in interest rates in the economy. Fixed rate bonds. Issuers promise to pay a coupon based on the face value of the bond. $1,000 par, usually 10% annual coupon bond, issuer will pay $100 a year, for example. So, how do bonds apply in the professional world? At the entry level, a consumer buys several bond certificates from a company for his family members to save up over time, and they eventually cash out. Mid level, corporations and governments issue bonds so they can utilize money and debt for funding schools, roads, etc. And at the executive level, the US government uses it to back their national debt to be able to use to pay off over time. In return, will turn back the money that is owed for those bonds purchased. Ethically speaking, in terms of bonds, we have to make smart investment choices. The government will always be backed with your currency no matter what you invest, but we have to make sure not to be greedy when we purchase these bonds because you have to pay off over time with interest. Luke 12:33-34 says, "Sell your possessions and give to the needy. Provide yourselves with money bags that do not grow old, with a treasure in the heavens that does not fail, where no thief approaches and no moth destroys. For where your treasure is, there will your heart be also." This concludes my presentation on bonds for week 5. We'll look forward to week 6 presentation next week. Thank you.